Would you guys say 58 points?
58, yeah.
Okay, so seriously, before we get into the meat, which is Johnson & Johnson, I want to do a segue on this. This is something that I used to teach to kids working for me, and I think this is a great example. 58's the over-under. So the equidistant put would be the 50 put versus 65 call. 65, yeah, 65. So you and me, Tom, if we're making our own sheets based on the 58 value of the over and under, 50 put versus 65 call, we're flat bid put, right?
I'm just trying to think. Yeah,
I think
yeah. What do you think the strangle's worth? $4?
No, I don't want to go to volatility. I want to start with skill. Here, you'll see where I'm going with this. Historically,
yeah, I would think that's about right. Yeah,
you're probably a big database for Super Bowls. Historically, aren't Super Bowls usually blowouts or ridiculously stupid low?
Well, not recently. They've been very competitive, close games. But yes, until about 7.
But you remember
some of the Patriot game in 07.
Right, I remember some of the Super Bowls before. Like the last 3-4 Super Bowls have been actually like entertaining, and the previous Super Bowls have been just blowouts.
Yes, that's correct. That is correct.
So
they've been better of late.
Okay, so 58 points. So let's call it 60. So that's a game of like 30-30. Does that suggest to you now? Before we get into the options again, I'm really trying to fine tune my sheets here on my skew. Do you think the referees let more offense take hold? They let it be a more offensive game for kind of like in baseball when they allow.
No, I think what happens is the fact that when you get these a lot of times they tend to be a lot of blowouts in these freaking games.
Right.
But
they were, yeah.
So you got teams that it's the finality of things, right? I mean, the teams press. One team gets behind, they start to press because they're down 2 scores, and here comes something. Here's a turnover, and
right. So you start taking risks. So you're down 21-7.
Game 7, right? Because you don't. Right. I mean, a corollary would be like, how many times, like you saw New Orleans, I think at the end of the half, run the ball out, 7 yards deep in the end zone with 17 seconds left, right? And obviously, why.
People shoot the moon a lot, and if they're down 21-7, 5 minutes left, the game could be them down 35-7 if they mess up.
Right. But interestingly enough, I'm just trying to think. It looks like the last since the Super Bowls became more competitive, if you will. You've only had one. I'm just trying to think. You had one game in the 70s.
Okay, so check it out. All right, so let's do this. All right, 58 is value for the over-under for the moment, for right now, right? Market's closed. We're going to trade the 50-65 fence collar risk reversal, put versus call. All right, the market is, and this is not obviously a pickoff. I don't know anything about this. All right, so I'm flat bid put at 4. Do you have any interest in the middle? You can tighten it up, or you can just join my market, and I'll tighten it up. We're trading options for these guys so they can hear how it works.
I would be, to be honest with you, I think.
No, we're trading. Don't be honest with me. Play all the games you want. It's flat.
No. I mean, I think it's if I was making a market, I'd be need a dollar either way. I think it's a dead even 3
one round. So on the equity side, it's need a dollar, -1, +1.
Well, need a credit. I'd say need a dollar credit either way.
So basically, if everyone's listening, what Tom's saying is value might really be almost a flat skew to the calls and puts. But I'm definitely looking at this market like the smile is skewed towards the puts because, in my opinion, and I don't have the database that Tom has for his sheets, but just the intuition, I just feel like I don't think there's a lot of games where both teams score 30 points. So I'm flat bid for the put, and if I'm flat bid it for put over, right? And Tom is need a dollar. He's basically saying pay me a dollar either way. The inside market now is flat bid for the put at 1 implicitly, right, Tom?
That's correct. Yeah,
that's the best market. Okay.
Yeah, you're even bid. I'm at a dollar. Yeah, that's pretty good because I would think if I was making a market on those things, I'd be. I think they're worth about $2 each.
Okay, you're saying a dollar. You mean so? I want to get the tick value right for everyone. It's $1 per point. That's what we're saying here, because it's a point over under.
Correcto. That's correct.
Do you want to make your tick value pennies, dollar? You know what I'm saying?
No, whatever you want. I'll do it for dollars. Keep it simple.
All right, so we'll do it for $1. All right, so I'm definitely one bid. Are you at one or are you at two?
I said I was at one. I sell it at one.
Okay, so I'll buy one at one and one at two. Is
Okay,
that fair?
fine. That's
All
fine.
right.
Yeah, no
So
problem.
we trade. So we trade. Our risk is, so everyone who's listening, forget about the pricing we just talked about. For every, let's just assume for the moment, I paid $1 for the 50 put, and I sold Tom the 65 call at 0. So if the point spread, if not the point spread, if the over under number comes in total points of 57, I lose. 56, I lose. 50, I lose. 49, I lose. 48, I start making money. Okay. Tom, who I think, but I think I understand his style here. Tom, who I think is not really looking at this like it's going to go over 65 points. I don't think he thinks he's going to make money over 65 points. But I do know this: he got paid for everything else. So
Yeah,
odds are, right? Is that your?
that's
That's your
exactly
style?
right. Everything between, if I sold it for $1.50, everything between 48 and a half and 63 and 66 and a half, I make money.
Okay, so we're going to go to Johnson Johnson. I promise, John
Yeah, let's
Hassinger.
do it. Go ahead.
But I want to finish on this point. Tom and I just traded the wing fence, the wing risk reversal, the wing collar, where he thinks I'm just going to exaggerate. I'm going to exaggerate and put words in his mouth. It's insane to think that that puts worth more than one over that call. But if I came back to Tom and I said, how are you on the 5660 collar or risk reversal? He probably won't be at one. Is that a fair statement?
5660. No, I would not be at one.
Right. And people that are listening, there's a very good chance, based on our options modeling collectively, that it will be under 58, under 56 versus over 60. But guys, there's just not really a big chance it's going to be under 50 versus over 65. The point is, when you price the 5660 collar or reversal or fence, you're pricing the heart of skew. And that might be flat bid at 4 for the put. But when you're pricing the 40, let's exaggerate, the 2100 risk reversal and fence, really? I mean, yeah, the put may be worth more, but is it worth more than $1? How much can you lose? So as you get further and further away from the at the money, the skew lessens. So if you look at the 5660 options, that 56 puts probably a 30 delta. That 60 calls probably a 30 delta. But we traded the 50 put 65, and those are probably 10 delta options. And Tom, we can both be right in terms of managing risk. Tom's like, I want to get paid. I'm not worried about the risk above this. We've had very few games under X, Y, and Z. And then the second part is I'm saying, hey, I like unlimited upside, even though I'm looking for the market to be lower, and I'm looking for a close game. So, and I rarely think that the market's going to go over 65, but I paid. So if neither one of our options goes in the money, who makes money? Tom does. And that's one of the principles behind a lot of his calendar relationship spreads. To get paid when vol is high, to do a back spread during earnings is an opportunity to take advantage of high implied volatility when real volatility will underperform, if you think that's going to happen. Is that a good analysis, Tom?
Yeah, that's spot on. Yeah, I don't really get. I could care less. I'm kind of agnostic.
Tom. I know you don't care less, but this is what I do. I like to talk about.
No. I don't mean it that way. You know what I'm talking about. Like the way I made that market is I'm kind of agnostic. I don't really bet totals or whatever. But I think 65. That's a lot of freaking points. I want to bet.
That's a lot of points, right?
You know?
I mean,
right.
the advertisers would sue if the score was like 54-5.
But I know you got to. Also, what you got to, I think you should mention to people is the fact that we're assuming, and I'm assuming, that, and I think it's good practice that I think if you were looking at this thing, you got to approach it from the fact that it might be a fluid vehicle in terms of like trading will continue throughout the game. So there's a good shot that we can both be winners in terms of spreading it. Like if you had a start. If it was like New England scored a touchdown with 30 seconds to go in that game to make it 14-0.
Right.
But if Kansas City doesn't call timeout, which I thought they should have called timeout, so I'm all agreed. If it's 7-0 at the half, how aggressively short the 50 puts do you want to be?
Okay, let's
Probably
put this
not.
in real. This is awesome stuff because I used to do this. Let's put this in real human terms. The market will remain open throughout the game
Yes.
or the over-under as well as the options. Now, Tom and I have direct dials to each other. We have a squawk box or whatever, and he's watching the game with his family, and I'm watching with my family. And after the first half, the score's like 30-0 New England. And at that point, Tom calls me because he kind of feels like he's in a good position, and he goes, "Where are you on the over/under?" And I say, "I'm still 56 bid at 60, meaning I think it's 58." And he agrees with me, right? But then he says, "Where are you on that 50 put versus 65 call?" And I'm like, crap, I'm no longer flat bid put because 30 points at the half, that's 60 points easily. And I'm scared. And now I may say to him, I'm one bid for the call. And he can take profits. And that's just with two people playing. But throughout, if you're at a party and people do a lot of boxes and football pools, I used to do boxes and then I used to hedge with bookies. And I'm sure you did something like that too, Tom, right? If you get low numbers and stuff like that, I used to love to arbitrage that stuff. But that's the point. If this market were open until the game, like right before the game, Brady gets a pulled hamstring, Tom comes back to me, he goes, "Hey, Vince," and it's just me. And this is the over-the-counter market. This is how people get killed. In the over-the-counter market, he's my customer. I'm the bank. He's the customer. He has to trade with me over the counter. Tom Brady pulls a hamstring. Brady pulls a hamstring, and Tom calls me up and he says, and I know he's short to put to me. I'm Goldman Sachs. That's Tom McEntee, billionaire investor, but you know what? I'm still Goldman Sachs. Tom says, "Hey, Vince, where are you on that 50-65 risk reversal?" And I'm laughing because I know that the game's going to be low scoring. Right. And I just bid it.
Yeah, absolutely. It's going to be
Right?
priced. All right, sure, absolutely.
And Tom's got reasonable. Before we make it fun, Tom's got a reasonable assessment. He's like, "Hey, Brady's out. It's a lower scoring game. I believe." That's an opinion, but that's what you create your valuations of. And I believe that the substitute quarterback's not going to do as well. And therefore, I think the chances of that 50 put being in the money are a lot higher. He calls up me. This is an over-the-counter trade. He can only trade with his counterparty, me. And he says, "Vince, where are you on that trade we did, the 50 put versus 65 call?" Now, I happen to know that he's short the put to me along the call. And even if the real market on the exchange is flat bid at 2 for the put, meaning Tom can only lose $1 and get out, because it's an over-the-counter trade, I can look at Tom and say, one bid at 6 and metaphorically give him the finger. Now, and Tom would be trapped with me as a captive client, which is why exchanges are better than OTC if you're a customer. If we were trading in an exchange, it would be me and 500 other people making a market. I'm like, Tom's a buyer, flat bid at 6. And someone out there who has the position on the wrong way is going to say, "I'm at 2, I'm at 1. And Tom will be able to get out at a reasonable level. And that's what transparency and free markets are all about. Unfortunately, we don't have those, right?
That's true. That's why you always want to avail yourself of as many markets as possible.
Right. Due diligence that came about from Sarbanes-Oxley is something that we do all the time in options. So if Brady gets a hamstring and you get a call from Tom McEntee out there, the market is flat bid at 6. Okay. All right, cool. So I'm long with 50 put, you long 65 call. I paid $1, and the market will be open during the game if you want to trade with me, Tom, just for fun. If there's a reason to, you can hedge yourself by buying, and we can make it a more complicated trade. But that's it. Okay, cool. I know you want to talk about it because we talked about it in preparation. I know John Hasker does. I know a couple other subscribers have been asking about it, and it's the perfect connection, the perfect nexus of earnings, Tom McEntee's love or I think excellence in trading event driven option structures, and you may already have something on, right?
For the Super Bowl? No, I told you what I wanted to do.
I'm on Johnson & Johnson now.
Oh, Johnny John. Yeah, let's put it up. I'm sorry. What do I got?
I'm sorry. I'm segueing. I'm saying,
that's all right. No problem.
We're talking about Johnson & Johnson because, number one, earnings are out today. Number two, Tom has been all over it and is familiar with the stock from multiple angles. And I'm familiar with it a little bit as well. And number three, it's a good time to handicap options trades because we can look and get almost instant gratification tomorrow morning whether ideas made sense or not. before you get really, I know you like to do this, Tom, but I want to do this
Yes.
for me as a learner. Okay. You definitely look at technical analysis when you're valuing options. I'd like to, if it's okay with you, and I think for the audience, so we can stay on the option part, is start with your chart assessment because those are pretty good. And then after your chart assessment, then we can see your reasons directionally for doing options trades. So unless John Hassinger has a preference, because I know that he's got a trade on too, I would love to hear Tom's technical approach before we get into the options. John, if you're out there, if not, we're just going to proceed. What would you prefer to do, Tom? Because I know you like to blend the stuff, but I can't keep it all in my head.
Yeah, sure. Johnny John, I think we spoke about it roughly pretty.
Met several times. So now it's time for an update, right?
Yeah. Okay. Well, I think it's here's what happened. We were. I think I remember the day we did this. I will. Let me see if I can.
Well, it started with
Definitely.
While you're looking up, the big sell-off. Anyone who's not familiar with Johnson Action was a result of not just the market selling off, but was a result of a warning, or I don't know if it was real or not, but anthrax or asbestos. I forget what it was, but it was a danger in some of their baby powder stuff. And the market sold off, and then it bottomed, and then it kind of rallied a little bit, but it flatlined. And the last time we talked about this was midweek or last week, and we were talking about, well, actually, Tom had it in his radar for the volatility is or is not where it should be. The market is or has not rallied. There's a play here somewhere possibly. And so here we are today with the market lower during earnings, but certainly within the channel that it's been. But the market just hasn't recovered like other stocks have because I think of the own problems that it has. So that's bringing us up to date. So what do you think of the last couple of days? Gaps higher, gaps lower type of thing?
Well, it ran higher with everything else on Friday. I guess Friday was get them all their hot day. So we got up to this 131 level. Look, I still I think we spoke about it was 130 and a half ballpark. We're looking at. I think we zeroed in like a 5% out of the money call with
That's
30
right.
days to go.
That's
I think
right.
they were like set up being like the Jan 30, might have been the Jan 36 and a quarters or some crap like that.
Weren't we both thinking? I mean, directionally speaking, and this is really important. I want to get the technicals and directional opinion right because it colors the strikes that you pick. Because we're using your strikes today.
Yeah. So I'm just saying we were looking at that stock at 130 and a half and
Right.
wanting to sell or selling the Jan 36 hybrid call, 36 and a quarter hybrid call at roughly $1.80.
Anybody who doesn't understand hybrid, hold on. Anybody who doesn't understand hybrid, what he's saying is if there isn't a strike, you make one up by picking one below it and one above it. So the Jan 136 and 136.50 call, you combine those, divide by two, it's a 136 and a quarter call. That's what hybrid means. Go ahead, Tom.
Yeah, that's exactly right. Yeah, that's fine. They were like the 25 and 37 and a half. That doesn't matter. Okay. And they were $1.80. And we had done some research and found a congruent call like all the way back on Thanksgiving. I think we looked at it. The stock
You looked at the last earnings, I think, right? Something like that.
Yeah, we looked. Well, it looked. I think it was the Monday of Thanksgiving week, so November 19th, and went out 32 days, which is the same amount of days we looked at for that January thing. And we saw that. I think we looked at it on 12/20 somewhere. It doesn't really matter. Okay.
But we looked for a parallel situation.
Yeah. Okay. I think that we looked for a 5% out of the money, 5% 32-day call, 5% out of the money, 32-day call.
Right.
And we went back. We went back a full month.
Right.
And at that point, you could have gotten 7 cents for that instrument. We're selling it for $1.80. Now, as it turns out, the stock's down roughly $2.80. Actually, as it turns out, I mean,
wait, am I crazy? Did you say that option was worth 7 cents, and now the equivalent of that option is $1.80? Help if I'm in the woods. Other people might.
Yeah, sure. Because when we looked at it on, I think it was December 20th or some. Yeah, we were looking at the January 18 expiration.
Right.
That's how that shook out, and that
that's right.
Call could have been sold for $1.80.
Right.
Okay. Now we said, hey, where is this in relative terms? To a congruent call. So we went back all the way back to Thanksgiving. So it was like 30 days earlier, and a 5% out of the money call in Johnson & Johnson with 32 days to go. The exact same. We're using the same variables. was 7 cents. And at the time, it was $1.80. So from any type of volatility perspective, it's a great trade. Okay. Unfortunately, the stock didn't comply. Okay. I'm assuming we could have rolled it again, I guess, last week because these things expired on January 18th.
But wasn't
On
part of our
January 8th,
conversation? Wasn't part of our conversation that proved fortuitous that if it goes higher, vol will come in, and if it
yeah.
goes
I mean,
lower,
as
vol
it
may
turns
stay
out,
out.
yeah. I mean, as it turns out, if we just carried this to expiration, and I'm not going to, whatever. If we carried it to January 18th, the stock closed at 130.64, roughly where we bought it, give or take a couple of pennies. Might have made a
Right, we
couple
bought
of
the
pennies.
stock and sold
And
it.
the options, we bought the stock at 30.5, closed 30.64, and the options are rip-ups. The options closed at zero, so you would have made $1.80 on it. Even now, if you would have kept the stock on, you're down roughly $2.70 in the stock, but you made $1.80. So now you own the stock, and you're in the stock for like roughly 120 to 70.
For people to understand a little bit about that trade, that's not a losing trade. See, I remember this conversation, and that was I gave Tom a loaded question. I said, "You're an investor in Johnson and Johnson. You're in it for the long run. What option would you sell?" And that's the option he picked. And then this month the market's lower. On that person, that investor would pick the same type of option. What you continue to do is, if the market goes lower or sideways, you continue to lower your cost basis. And so that dividend he created. So yes, the stock's lower, you're not making money. But to echo something that Larry said today, you ain't selling it. If you didn't sell it on the lows, you're not selling it now. And so, you're hoping the market goes up. So it's not a bad trade. It's not a bad investment. It's not a bad dividend. It may be a bad short-term trade, but that wasn't an earnings-based trade. That was us trying to do a covered call or a call right for an investor who liked Johnson & Johnson in general. Now I remember exactly what that was about.
Yeah. That's. I think I don't know if it was Sunil or Johnny Hassinger. I'm not really quite sure, but
this is a different story now. Now we're looking at an event. And
so what I've been doing here, I have. What did I do here? Here's what I have on it, Johnson & Johnson. At around that same time, I kind of think, let's go back to the chart again. I'm sorry. New window. Here it is. Never mind. Hold on. Let me pop this out. I kind of think this number here is, what is this, 121-ish? Yeah, 121 even. I think we got some, we got as high as 149-ish, 270. What is that? 135 on the high side. I've been looking at that. I mean, I think this 135 level is probably in play. And to that end, what I've been doing is, and I have done, I've been selling. And let me see if I can adroitly.
Please explain to me. Please explain to me. I'm really thinking about doing it. You were my banker today. I'm the customer. Okay. Why do you think the 135 levels in play? This is a technical and an opinion concept.
Yeah, I'm just a fib. I'm a big believer in fibs. That's
fine,
all.
But your rationale is what's important.
Yeah, that's right. It doesn't mean I'm right. I mean, you got to have a process, right?
Do you think we're looking at a trade? I'm sorry to keep walking over you on this, but this is kind of important to me. Do you think that 135 is in the potential range today with earnings coming out, or are you looking further down the road?
No, I mean, look. I mean, I think. Look, I mean, the stock earnings, I guess, underwhelmed. Obviously, the stock down a bit, but I think it's kind of bottoming in here over time.
Okay.
This was a binary. I don't know if it's a one-off. I would assume it's a one-off, but this is a binary event. Spike low. I think you got some holes here on the upside. I think I would look halfway between 121 and this old high of 49 is 135. Coincidentally, that's kind of where these move.
There you go.
200.
Okay. I understand your rationale.
133, 134. So here's what I want to do. I want to take a look at that 35 line, and I want to take as cheap a look as possible. So to that end, I'm going to see if I can move you down here.
So you're in this trade that we're looking at, you're looking at the earnings as a potential opportunity to buy a call and finance it with a shorter dated call because you think 135 is on the table, maybe not today, but over the next 30 to 90 days. Is that what I'm starting to hear?
Yeah, that's exactly right. So what I had done, I think, at that particular point in time, so I think 135 is in place. So I think 135 on the high side, So I'm saying, wow, at the time, the vol was so ridiculous and so steeply backwardated that you could really get, you could take in vol credits to do these things by buying time, which I'd love to avail myself of. So this is the spread I have on. I think I paid 20 cents for this. I bought the April 40 calls
right?
This is a month ago.
Understood.
The April 40 calls sold the Feb 35s. I think I paid 20 cents.
Okay, hold on. I'm writing this down. So you sold the Feb 35s and you bought the April 40 calls, a net debit of 20 cents.
Right.
You got a diagonal spread on, and even though you're paying 40 cents, if earnings weren't about to come out or volatility wasn't so backwardated, that spread could easily be worth $1.50.
Yeah, well, it's currently worth about 45, 46 cents. I mean, I paid 20 cents for it.
Well,
It's
post
right
earnings
now.
could
It's
be
got a
worth more.
slight
Yeah.
delta. It's got a slight long delta, but at the time I did it, it was pretty much delta neutral because of the inflated
Right.
volatility in the Feb options. So I thought that was a pretty good way to play it. Play that
Right.
135 line.
Right.
If I get to 133, 134, which I kind of got to on Friday, it's a home run. Like this would be great if we push back up to up to Friday's highs. These calls, these 35s are going to be source of funds, right? You know what that means, right? They'll be at all the heroic buy riders will be.
No, I know what source of funds is, but I want other people to know that.
So
Explain
I
it.
don't think these are going anywhere. I'm going to have a free runner with these because I still have 2 months in time. So what I'm
So
trying to
source
do
of
now is
funds is a tongue-in-cheek way of saying if you want money, sell those calls.
right, exactly
Okay,
right.
I want
So
people to understand that. All right.
So what I'm trying to do, and I have an order in right now. It's as of right now, it is untenable. I am trying to buy these back. I want to buy the Feb 35s, and I'm looking to sell March. What was I trying to sell? The March 36s. Let me see what my order is. I'll tell you exactly what I'm trying to do here.
Okay.
Uh,
So you're tightening up your position. Short.
yeah. I mean, it's $130 stock.
I'm just trying to get in your head, Tom. That's all I care about is getting in your head, not your pants.
Yeah.
April 140s.
Fortunately, not
Okay.
enough people.
So your
Not
initial
enough
trade
people
was
want
short the
that.
Feb 35s, long the April 140s. Was it the
Yeah,
April 140s? All right.
yeah. I'm
For a
long the
20
April
cent
40s.
for 20-cent debit, and
Correct.
now it's worth about 40. And now you're basically saying you still like the April 140s, but you want to possibly change your Feb 135 strike for
Correct.
whatever reason you have.
Yeah. What I've been trying to do is I'm trying to buy. I'm going to flip. I'm going to buy. I'm bidding. I'll tell you what I'm bidding.
Okay.
I want a 61-cent. Yeah. I want to buy the Feb 35s back. I want to sell the March. I want to buy two. In other words, if I'm short 100 of these,
I'm with you.
I want to buy the March. I want to create. All I'm doing is creating a hybrid 137.5. You see this here with the 40-35.
Okay. Let's start with real numbers, even though they're not your numbers necessarily. I'm going to throw numbers on this. The initial trade Tom did how many days ago was shorting the Feb 135.
It's got to be. It's got to be a month ago. Yeah.
Okay, fine. So 30 days ago, Tom sells 100 Feb 135s. Right. You guys should write this down if you're trying to learn. And he buys 100 April 140s. I'm going to make numbers up. Okay. But actually, I'm not going to make numbers up. I'm just going to say this. The value of the spread was 20 cents. He paid 20 cents, the April option over. Okay. Now that spread is worth about 40 cents, the April option over. And we still haven't had earnings. So Tom's going to take that Feb 135. He's going to roll it into something else, depending on his directional and volatility point of view. So it's 100 by 100. Now you're going to do a ratio of some sort. Is that what I'm
Yeah.
saying?
Well, now I'm going to say I'm short 100 of these 35s.
Right.
So I'm going to buy 100. That way, the way TT looks, it's just this isn't really.
That's
important.
okay. You're closing out.
I want to buy 100 of these 35s back. I'm sure. When they get to when they're under 30 cents and there's a month to go, 3 weeks to go, I don't need that freaking risk.
Well, there's an old cliche. There's an old cliche if I can throw in on the commodity side, and you may have that staying on the equity side. You guys are a lot more classier than us, and we would say things like, "Don't be a tick dick." If the option gets small enough where you really can't make much money, there's no sense in being shorted. So under 30 cents, you want to cover that, and you want to roll your short into what?
I want to sell a hybrid 35. I'm going to sell the 137.5 hybrid in March. Okay.
So you're rolling 30 days back, and now you're rolling your short back tighter with April.
Correct. So I'm offering this thing. I want to buy two. I'm going to sell one of each. So I pay 28 cents for two of these, right? So that's 56 cents. And say I sell these at what is this, $1.11? So it's like 55. I'm offering the thing at 61. I'm going to need this. I'm going to need the stock to
help me out with this. All right. I understand.
Yeah.
You're going to cover your 135. I want to be totally clear about this. The first leg of this trade is you are going to buy 100 Feb 135s, closing that open interest out, right?
Correct. That's correct.
Right. And what are you looking to sell? A ratio of 1 to
1. I want to sell a blend of the March 35s and 40s.
Okay, fine. The strike. So basically, everyone who needs to, like Tom's talking hybrid here. So he's going to sell the 137 and a half call. All right. He's going to make it up in his own mind, and he's going to basically sell the risk of the 137 and a half call. And are you going to do that 1-to-1?
Well, I'm going to buy 100, say Feb 35s, and sell 50 of each. So to create
Right.
it.
Well, that means 1-to-1.
Yes, yes, correct. Yeah.
I don't want to get too hypothetical with that.
No, that's fine. 1-to-1. That's cool.
We're trading OTC. You're selling 100 Feb 130. I'm sorry, 100 March 137 and a half calls. All right. Now, before he gets into the actual guts of this trade, I want you to think broadly of the risk. He did a spread where he sold a February option and bought an April option, and he did that because he saw, and if I'm speaking out there, let me know, the Feb backwardation was higher than he thought it should be, and that's an assessment based on years of trading. And he did not see the Feb gamma as being something he was worried about. Now, 30 days later, and the earnings haven't come out yet, he's actually doubled his money on the Feb-April diagonal spread, the Feb 135 versus April 140. And now he may be saying that, you know what, the Feb option's under 30 cents. It's really got a smaller delta. Not only do I feel long because the April option has held its meat more, but I actually feel like even though the Feb 135 is a nothing option, its gamma is very digital. And that means it's got a lot of gamma. So it can go from a 20 delta to a 40 delta in a very quick move. And there's not really a lot of premium to collect in that. So I want to take that Feb 135 and just titrate or minimize my risk, my gamma risk, and roll it into an option that's not only a tighter relationship with April, but gives me more premium to collect. So he's parlaying his bets and tightening his risk at the same time. So talk to us, Tom.
Yeah. So what I'm trying to do is, So what I'm doing here is I am going to try and sell this spread. I'm going to buy these 35s back, like Vince said, and this is exactly what it is. I don't see the intelligence just being short this thing for 27 cents. I also want to protect my April 40s. So in a way, it's kind of like a chess game. So I want to protect my April 40s, which are going to, as we push forward towards and through Feb expiration, I am going to be battling the headwinds of decay. So I want to buy these back, and I know I can sell. These Marches are still somewhat elevated to where I can buy these Feb rip-ups, these Feb calls back. So I want to buy these back, and I'll sell a blend of these, a synthetic 137 and a half. Essentially, what I would be left with, if I get it done, I think the market, as you can see here, is it's at roughly a 55-cent credit. I want to sell it for a 61-cent credit. Now, that'd be great. If I get this thing off at 61 cents, and I probably need a little, if I get it off at 61 cents, I would be really in a catbird seat because I would be long the April 40s. I'm still long them, and I'd be short the March 37 halves, okay, that hybrid, at plus 41 cents. I paid 20 cents for the April 40 Feb 35 call spread. I'm selling the Feb 35s back. So I'm long the April 40s. I'd be short the March 37 and a half call, and I'd be plus 41 cents. And that gives me a lot of room. Now to think and press 135 and go through 135. And I have no real risk. I got a real good look at the upside here. Okay. So I think this is, if I get it off, now Bulls, Bears, Pigs, I probably should go down and offer to 55, but that's the way I play the game.
Right.
Because I'm Irish and I'm a little freaking stubborn. So that's kind of the way I'm doing it. So, I mean, this is all you want to do is, you want to look at these things and then look, this is one that worked out. That's fine. Plenty that don't work out. I'd rather.
But the ones that don't work out, don't.
The ones that don't work out, that will show you how talented I may or may not be. You know what I'm saying? Like anything else, you can talk to anybody who does this for a living.
Right.
It's the ones that don't work out that prove your mettle. Everywhere. I could turn this over to a 9-year-old when things are going well.
That's right.
So
if you want to know how Tom is doing, just check with his pharmacist. The higher his Xanax dosage, the worse he's doing.
Yeah, so that's kind of where I'm at. So if I get this off, now I'm in the catbird speak with Johnny. I still think it presses 135. Here's what I'm looking at, guys. I don't know. I'm not that freaking talented technically, but I'm just looking at this. You can't see it because I haven't shown the here. This is, you get that right? Okay, here.
Yes.
These are 50. These are a bunch of stocks on my watch list here.
Stay on J&J. Stay on J&J because I want to ride this home. This is a trade. It's a good trade.
Yeah, hey, J&J. Look, here's the 200 day. The 20 day is 130. 50 days 133.5 to 200 days 33.67.
Okay, you're going back into technical analysis, guys.
Yeah. No, but what I'm saying is this is kind of why I like it. I mean, I don't mind having this as a long against some of these shorts.
I'm not trying to steer you off of it. It's really important when you trade, and I don't trade generally the way Tom does, but I have to understand it because guys like Tom are my counterparty. I understand that he has a directional bias, but he's not married to the bias, and he's okay having that bias as long as he's not spending too much money or if he's getting paid money to express it. So the direction is really an augmentation of his understanding of volatility. It's the volatility that comes first. But if he sees a chart that says, "Hey, if I see three stocks that are in the same situation Johnson & Johnson is, meaning their earnings are coming out, and I'm trading like Tom, I see three stocks that are going through earnings today, I'm going to look at those three charts. If all their volatility situations are the same, I'm going to look at all three charts and say, which chart makes me feel the most safe in my idea?" And that's why when you trade these diagonals or calendar spreads or event earning, you have to have an opinion because that opinion directionally, even though you're not married to it, helps you decide because the volatility is the volatility. You know that like the back of your hand. You have to have an opinion because that opinion helps you decide A, when to roll when you're right, and B, when to get out when you're wrong. And I think that's why you keep coming back to this technical analysis. It's important for understanding directional trading options.
Yeah, absolutely. So I'm just looking at that. I just want to, I mean, I've said it a million times, but I'm just trying to leverage technicals with volumetrics. End of freaking story. That's all I try and do. If I can leverage the two of those, I think I got a good trade going on. I just want to have as many things going my way as possible, as many things I think going my way as possible. That's Johnny John. I think it's interesting. I still think, I mean, I even think that spread right now, if you did the April 40, where are the April 40 calls? 75 cents. So you got, well, it's probably about 19, what is that about? If you do it for 30 and 75, 45. Yeah, it's about a push at this level. If you did it, maybe a slight edge to you, but I think something like this is good. Here's another one. That's Johnny John. That's what I've been looking at. I mean, just trying to take.
No, stay with Johnson Johnson. I have questions.
Go ahead. What do you got?
I have questions about Johnson Johnson. Okay, let's say you do this. You do this trade. Let's say you just did it. You rolled your Feb 135s. You covered them. You're flat, and now you've tightened up your diagonal call spread to really be a 137.5 expiring in March versus a 140 expiring in April. Diagonal call spread. Now you have a net credit of 40 cents. Here's my question to you. Based on now we're talking volatility. Based on where the vol curve is now and how markets and how individual stocks act after earnings, do you think if the market flatlined after earnings and vol came in, that this spread would make or lose money?
Excuse me, I'm sorry.
You know what I mean?
If vol flatlines, I mean, I'm going to profit on the decay. I mean, the vol's down about 17, I think, now in Johnny John's. Obviously, remember when we got involved, we were selling that front month thing at roughly 28, 29. It was jacked.
I know. That
Might have
was
been
fat.
higher. It was ridiculous. Yeah. Hey, well, whatever. Yeah. I mean, you got to let somebody's on the wrong side of something at some point in time. So,
but I'm saying, even if the market doesn't move and if their earnings are a non-event, do you anticipate this spread, this new spread, in and of itself? Let's say that I'm putting this spread on today and I don't have your Fed position. I'm going to sell the March 37.5s and I'm going to buy the April 140s.
Yeah, I like to, you know why? Because I think it's a fair price. Yeah, I think it's a fair price to pay. And I think I like I like the technicals. Okay, so I think I got one of the two things.
What I'm getting is you're rolling. You're rolling
exactly.
And you're parlaying a profit. But this trade, even as a standalone for a guy like me, you like as an initiating trade.
Yes.
March versus April.
Yes.
30-day diagonal. Okay, I'm just trying to understand. Okay, cool. All right, I'm with you.
I mean, it's a minimal debit. I mean, it gives you a free look into this thing, which I think is always what you want. You always want to avail yourself of that. I mean, I talk about that a lot, but you know what that means. I want to function. I want to express a directional viewpoint as cheaply or as expensively as possible. That's it. You know what I'm saying? If I like the thing and vol was ridiculous, I don't mind selling. I'd sell some put spreads and stuff like that. Where I got paid. That's all I care about. All I care about is getting paid. Doesn't mean I'm going to be right. I just want to get paid. I'll take my chances after that.
Okay. Let me ask you an earnings question because before you move on to whatever topic we're talking about next. Um, Johnson & Johnson is down a little over 2% today. The stock market, the broader market, is down about 2%. How much of the Johnson & Johnson move today, just from your watching the tape today, do you think is pre-earnings anxiety versus stock market heaviness in general?
Well,
Or is that something you haven't handicapped yet?
no, I mean, I think
You know what I mean?
Johnny John. I mean, they had earnings already. It came out already. It came out this morning. They were BMO, I
Oh,
think.
dude,
Hold on, maybe
I thought it was afternoon.
wait,
Oh,
I
crap.
could be
Never mind.
freaking wrong. I wasn't trading it on. No, you could be right. I think it's
No,
this.
I thought they were after the close.
Hold on,
Just
maybe
tell
you're
me to
right. I
stick
have
with
no idea.
commodities. That's okay. No, no,
Johnny,
no, no.
earnings are
It says today, but I don't know what time.
22.
You know what?
48. Yeah, 42.
Estimate is 191. That's the consensus estimate. But what's the real?
BMO.
Did it come out?
Yeah, it came up before the market. Before, but this morning. Today's GN 22, right? Yeah, it came out already.
Oh, see, I have a commodity setup. My earnings are not as updated as they should be. Okay, I
That's fine.
understand.
No. That's yeah.
That makes the trade even better. That makes the trade even better.
Yeah, I think
Now I
I
understand
think
what
you
you're
already
doing.
knew this, so I wouldn't worry about it. I think it's a good freaking play. I like that play. I think that's a real cheap way to play to have this stock hopefully, I think move higher. I think it's a little bit overdone. I think it probably does trade higher. I think it's a cheap way to play it. And look, and if the stock craps out down at 121, well, you lost 45 cents, and it's on to the next one. But you got to
Right.
realize now, if the market, you're long Vega here, you're long volatility. I don't know how much Johnny John Vol is going to come in the next 3 weeks, 4 weeks. I mean, the median 52-week median for this thing is roughly, about 15, 16. We're trading about 17. I don't mind owning it here. I don't mind owning it at 50% premium to where, Vol usually resides because I think it's cheaper than
Right.
17.
Right.
I mean, if it's 17, I don't know where we're going to go in this environment. That would
No, I
push
understand. If we go higher, let's say back up to the 140 area, vol's going to come into maybe 3%, which puts us near the mean again. If we go lower, it's going to go higher. So being long
So I
call,
mean,
being long call is
correct.
not a
I'm
bad
long
deal.
Vega. The spread's a long Vega spread. I mean, that particular spread's long Vega. I'll give you the exact parameters. The 37 halves are roughly figure about seven Vega, and it's 12. So you're long about 6 Vega. So
Right.
if you do it one time and Vol goes up one click, you're going to make $6 just on the Vol move without taking into account the amortization of the options, because you got to realize you've got theta, right? Because I mean, you're short of the nearer term options and longer the longer stuff. So you've got theta going for you.
Right.
So you make money on theta, because and you got to realize the theta is going to be more geometric in nature the closer we get to Feb expiration.
Right.
So I think that is something to. That's why I like this is a real good spread.
So as a long side player, I'm thinking of it this way, just based on what you just said, just taking what you said for this conversation as gospel. We are closer to the median in vol, even though, in my opinion, the market is certainly not at a happy place. So in my opinion, I would think that a rally is probably going to knock vol down. A $10 rally knocks vol down 2%. A $10 drop raises vol more than 2%, I think. So I'm thinking this. I'm thinking as my own style of trading, as a long style trader who definitely does a lot of diagonals, but not the way you do. I would say I think I want to buy a 30 delta put over hedged, because I think this market, I think the volatility's got a floor in, and if I over hedge it, I'll make money. If I under hedge it, I'm going to make money too. You know what I'm saying?
Yes.
It's kind of like the flip side of that. If you're a short side player, you would be a seller of a 30 delta. No, you wouldn't. You would be a seller of a 30 delta call and a under hedger. No, you'd be a buyer. You'd be a buyer, because we're basically saying vol is closer to the bottom than the top. So I'd be a buyer of a 30 delta put and over hedging it. Yeah. And, or I'd be a buyer of a 30 delta call and under hedging it. It would be a buy side situation, net, based on what you said, in my mind.
I would agree with that.
Yeah.
Yeah.
Okay.
I mean, that's kind of way, the way I did things in there. Like, we also remember we brought up Netflix. Look, not just because it's
I know
different.
that's
I didn't
definitely
get the
worth
trade off.
revisiting.
I didn't
No,
get the trade off.
are we done J&J? Are we
Yeah, we're
done
done.
J&J?
Is everyone okay?
Because
John
Netflix is kind
Hassinger,
of Netflix is good.
John, you okay with this?
Don't we have a trade on Netflix, you and I?
No, I know. Yeah, I wore that one, brother. I wore
You
that.
wore it?
I wore it.
Oh, man,
Where'd
I'm
the
so
thing
good at
close?
this.
It was $30 for the 55 straddle. It
You could
closed at
just say you
39. I
DK
lost
it. You could say
$15.
you DK it because I don't even remember it.
I don't do that. I'm a guy who used to throw. If the quarter missed the toll bucket the first time, I'd make sure I'd get out of the car and
What
throw
was
it
the
in.
trade? I know we just did it just to
Yeah,
have something on.
you sold me the 355 straddle at $30. The 355
I
straddle,
sold a
$30.
straddle?
Yes.
That's disgusting. I would
Well,
never do that. Are you sure?
yeah, and it was a $14 winner for you. So
I must even in the
you're
sell-off?
gonna have to pay your disgust.
Wait, even in a sell-off?
Stock only went down $15.
I know, but that didn't imply vol blowout. I know that we
It-
expired
it-
the option today, but
we
generally
did.
speaking, in reality, that option, those straddles, will be worth more, right?
No, we did it expiring Friday. So one day.
Oh, I'm so smart.
You were
So you owe me a
very,
dollar. You owe me a dollar, right?
yeah, I owe you a buck.
All right, so we'll let
owe you
that
a buck.
run, and when we finally settle up, if it's okay with you, I like to do this with friends of mine, and you're definitely a friend now, for better or worse, right?
My wife tells me.
When we finally settle up, the payer has to pay the other person with a single dollar, and it has to be signed by them and framed. This way, it just goes up on the wall. It's like or you can be a check made out for a dollar. I don't care. The point is, it becomes more of a trophy than a dollar.
Yeah, right.
Okay. All right.
It's
All right.
personal.
So I think I'll probably be losing after the Super Bowl. So we'll be flat there. Yeah. Netflix. Wow.
Okay, so I mean the trade we like there, thank God I didn't trade with you on that double thing. Just sucker. Like I said, I didn't get it off. Didn't get it off. We were trying to play that thing. I wasn't willing to. We were trying to play. I think it was a 10% mover on a 1-day basis, and I think the thing was most attractive was to sell this week's 300 put and buy next week Febo 1 expiration.
I remember that it was a Jan 25
295
Febo 1 type of spread.
Yes.
Something like that. Yeah.
Yeah, and that thing was, this is what a jackass does. I bid 36 or 35. It was at 41 or something like that. Currently about $1.20. So I should have just freaking paid it, or just bid market. I would have gotten filled. It would have been a dynamite trade. But you see why that trade works,
right?
I mean, delta wise, it's a small negative delta, but I'm taking it. What happens here is I'm highlighting the implied vol of the Feb 295 puts, roughly 57.
Right.
And these are the Jan 25 puts, roughly 72. Now, I think when I did it, I was taking in, so it's roughly a 15 vol point skew between the 300 put and the 295 put currently. Okay. So I could take in 15 points, but I think when I did it, or when I tried to do it, I didn't get it off. It was roughly about 35 clicks. And that is a big reason why this worked. That's why that and the stock obviously heading lower. There's a slight, very, very small negative delta spread. That fact, and plus the vol skew. So when you're able to take in that kind of juice, I mean, 30 clicks doesn't look. I mean, I won because the stock only moved $20 the right way on Friday. If I moved $20 moved to 375, well, it's a different story, right? I'm a loser. But it went my way, and that's that kind of dovetails into where I was technically. I think we spoke about it.
Yes, we did.
We talk about where it got to, that 356 level here. It got this is earnings, I think, on back in October, right? Mike Arinovitz told me, what if the stock trades at 400? I thought he was huffing glue at the freaking time, and he indeed was right. It traded 409 after that. And I think the next day it got to 385 was the high. I'm sorry, 380 that day, and then really that was it. Kind of, if you look at this, I don't know what I mean. It's really not, because this is higher, but you boom, 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 and then it's off and running. I remember the low that day of earnings. You can see here the low that day of earnings. You can see right there. So you won't stay. The low that day was 356.50. Okay, and then indeed, I mean, it might have traded 358ish, but that was that. And it was hard down to that 230 level. And I think we got up here and kind of rounded out at like what to get to 358, 359-ish, and then falling. So that's kind of the reason why we structured a negative delta trade. Like, I mean, look, all these charts look the same, right? Is it a V bottom? I have no idea. They've gone down, recovering roughly half, and down again, and then this V spike with holes in it. I just think this thing has got unfinished business, at least down to here, probably down to here. So I just think you got a question of every jackass dumping and getting short, chasing. I missed it. I got to get it off the news. Didn't some news come out? They raised prices, something like that.
There's a lot of news, and Elon is
maybe tonight
his
if you
recent
have a
tweets
free
have been.
second.
That was Netflix. So I think that's where you're at with a lot of these things. I think you had a lot of people chasing these things. I think I put up some vol charts last week that I thought would be. Look, I mean, I put them up on Wednesday to be fair, and we're probably in the same spot, or maybe a little lower than where they were when I talked about them. The volatility in VIX options was at a level since back to December 3rd, back to the time we traded 2,800 in SPX. I thought that was at least alarming. After a 300 handle rally, nobody won options. It's incredible. 330 handles, 14.5% in 3 weeks. This isn't some freaking biotech. The S&P 500 rallied 14.5% in 3 weeks, and nobody wanted protection. Incredible. Incredible. Why would
unless you were Mnuchin's secretary and you knew that?
Well, yeah. That's true. That's definitely true.
But that's true. People lifted their hedges and bought stock. Anybody who understood what was going on, believe me, it happens. And I'm sorry to be paranoid about this. When a federal government says they're going to guarantee a company, Sears's underfunded pension liabilities, they're rescuing workers. And how do you also rescue people that have money in pensions? You support the stock market. Believe me, I'm not wearing tinfoil. There is a mandate unspoken to keep stability in the equity market. The problem is they're biased stability lower. They don't put caps on rallies. They put caps on sell-offs. And that's an unspoken mandate. And the paranoid point that I'm making is that a 17 or 14 or 17% rally in 12 to 17 days without and nobody's buying options in the first leg of the sell-off. That's people that were dumping options because they got the go ahead that it was okay to do that. That's all.
Here, this is a chart of VIX. I think a better chart would be the front month, whatever the generic front month future might be. But that's okay. This is a chart of VIX, and VIX is a stat as we discussed before. So I'm not really a big believer in support and resistance and all that crap. I just look at it. Okay, so I think in here, but now this is 30-day at the money vol in VIX. I mean, roughly hitting 160-ish, 159-ish over here on 2 days after Christmas, when it's the end of the freaking world, and I just will pay any price for black swan freaking calls. And now we get this freaking rally, and here it is. It's back down to levels you haven't seen since late October.
That's right.
So, you know what? They don't ring bells for you at bottoms and tops, but every now and then they give you stuff like this. And I thought that was at least concerning. Look, I put that up there with 263 spider or whatever the hell it was, 10 handles lower than here. And we went to 2670. So I'm wrong. But I think in the long run, I don't time things. I'm terrible at it. In the long run, I think I'll be right. And I think you just saw a tremendous amount of complacency in a short period of time. But it's because it's like anybody else. Everybody's freaking wrong. I'm wrong. I panic. Everybody panics, right? But I think you saw here is a market that all of a sudden everybody got whipped on the downside, probably net short at the 2340 level in there, because it went down every freaking day, right? And then I think we got to 2400 and people started to shoot against it that day after Christmas, or the 26th, I think it was, and then it exploded. There was a 100 handle up there, if I'm not mistaken, on the 26th.
Right.
I think I'm right.
I think you are.
And then people pick spots along the way. Look, I pick spots. I thought 25.33 was a spot to be flat. I thought 25.73 was a spot to be short. I thought 26.40 was a spot to be short. It went to 26.75. I'm wrong. or I was wrong. But that's that's it. But I mean, what I think you have here, you got discussed in VIX because the typical right. Who buys vol? Who's buying vol at 23.40 SPX? Guys who are short it, and guys who just think we're going to keep going lower. Now I have to own it because this is where easy money's being made. Well,
Right.
those guys are usually freaking wrong. Not always, usually.
Right.
So, and I think that's what happened. And now they're all chasing it. Now what happened? Now the coast is clear because what? Because someone came out and said they're going to raise tariffs on China, or, lift tariffs on China. But he came out Saturday and said he wasn't going to do that. I think that's what he said, right? I thought I saw him during Chopper Talk, whatever the heck.
Yeah. Well, the problem, I know I'm not going to distract you. I want you to stay on what you're talking about. But among the problems with China is if you go back to the last basically three events, is one, Trump was optimistic, or he was conveying he was optimistic. Two, Lighthizer said, I'm not so optimistic. Three, even though other industries like grains and other things that China buys from us are if there's a violation or there's a problem, we're working with them and either fining them or cutting a deal. It's the technology sector now with Huawei that we're trying to extradite. That's really a fly in the ointment. And they're probably talking at Davos as well. But who the heck knows? It's just words. It's rhetoric,
Yeah. So, let's, I'm just trying to think here. So we did that. I got Proctor on, fellas. Take a look at this. I'll give you one quick one, then I got to roll.
It's 10 after 3. Before you get into Proctor, I want to mention something. I put a chart up earlier, and this is for the guys that have been. This is for people that are relatively new to options and want to learn more. And although there's a ton of stuff in here, you may feel that you'll have to listen to it 3 or 4 times, and I encourage you to do that if you have the time. But there's a chart I put up there, and it's about J&J. The most important thing about the chart is to understand the terms. When you look at a technical analysis or charting system and you put up HVOL or historical vol, you're putting up what is called historical volatility. So if you're putting up and you're looking at historical volatility on my chart for the last 5 days, that's the blue line, HVOL 5, you're looking at a daily chart, historical volatility. What is historical volatility? Well, people also call it real volatility. I don't want you to think about the word real as in real versus fake or authentic versus inauthentic. Real is short for realized vol. And implied vol is options volatility. And options volatility attempts to handicap or predict the future realized volatility. And that's the difference. Implied volatility is a gambler's tool, okay, or a handicapper's tool, if you will. And real volatility isn't real or fake, it's realized, meaning to the extent that implied volatility is realized in the future, it was justified. And I just want to leave beginners with that concept. Implied volatility predicts the future. Realized volatility is volatility.
That's correct. That's right.
I'll leave you with that. So you want to do Procter & Gamble? Tom, I'm going to jump off. Is that okay? Because I have a call to do. You want to finish Procter & Gamble solo?
Yeah, that's fine. Go right ahead. Good being with you, Vince.
Thank you very much. And
take care.
Thanks for the Johnson.
If we want, what we could do is pick that up on Thursday.
Done. I get some practice up. I'm a little jammed up. I will put it in the chat. What I've done so far today, what I'm looking at, and we'll pick it up Thursday at 2.
All right, sounds good. Tom McEntee, Vince Lanci, great information.
Great. Thank you so much, Michael. Great being with you, man.